It is the final trading day of the month of February, and investors are now pricing U.S. rates peaking at 5.4% this year. It follows recent economic data that likely reinforces the idea that the Fed will keep on hiking. So, is there more volatility ahead? And where are we? Are we anywhere near a bottom for stocks? Here to discuss is Matt Maley, Miller Tabak Managing Director and Equity Strategist. Matt, always a pleasure to get some of your insights here. As we close out February, what's the setup looking like for March?
Well, it's funny. One thing I will say, it's interesting how we've had in the past, everybody talks about how the October is kind of when we see these big bottoms. But actually, we have seen big bottoms take place in March. The problem is sometimes those don't take place until later in the month and after a fairly big decline. That certainly happened in 2003 and 2009. But after those big bear markets. But my big concern right now is that we're still, at a situation where the market is still overvalued, and certainly not as overvalued as it was, a year ago. But every bear market since World War II has always taken the market to an undervalued level, to at least 15 or actually below 15 times earnings, and we're nowhere near that. And with interest rates continuing to rise again, and of course earnings coming down, earnings estimates coming down for 2023, that I think is going to create some more headwinds as we go through into the month of March.
Hey, Matt, it's Julie here. So to get down to 15, how much further would we have to go to get to those kinds of levels?
Well, the problem is that that's below last year's lows, and that takes us down, below 3,500. I'm afraid on the S&P 500, and that's just assuming that and that's assuming that earnings don't fall any further, for earnings estimates, that is, and that's a big if. Now, some people are calling for the hold up. Right now, the consensus is about $220, but a lot of people are looking for it to be lower. So it could be a rougher year than a lot of people are thinking about. And again, I'm not calling for the end of the world here. It's just a situation where valuations got pushed so sky high, at the end of 2021, just like they did at the end of 1999, that it takes longer than usual to get it back down into line with get the market back in line with its underlying valuations. And again, I'm not trying to say that we didn't get as overvalued at the end of 2021 as we did in 2000. So I'm not calling for that kind of a bear market, but I still think we need a bigger decline to again match things with the markets with their underlying fundamental values.
I'm glad you're not calling for the end of the world, because as I remember one of the New York Stock Exchange traders, him saying in my head one time that you can only be right about that end of the world trade once. And do you really want to be? At the end of the day, even if we are to see some strength in certain sectors, if you are sector picking or stock picking, where does there look like there's the most resilience or strength to you right now?
Well, a couple of areas. One is just in the defense aerospace area. We've had this situation where early at the very beginning of the year, a lot of these, the Raytheons and the Lockheeds, even Boeing, which they have their own issues, but those stocks got hit pretty good over the thought that defense spending was going to go down quite a bit. Remember when McCarthy was trying to enough votes to be elected Speaker of the House? Well, that's kind of drifted by the wayside. And if anything, the world's become a more dangerous place in the last month or so. I mean, with what's going on with China and Russia, Ukraine, and we're obviously ramping things up with what we're willing to give Ukraine. The situation between China and Taiwan has not gone away. Israel is still very concerned about what's going on with Iran. So I think defense spending is going to pick up nicely, and if anything, it's going to get higher, not lower. And a lot of these stocks, I think, could look quite good. Even a stock like Textron, TXT, which is a lot cheaper than some of the other names. It's not one you automatically think about when you think about the defense industry, but that's a good play there. So that, and I also think the oil sector is going to, it won't have as good a year as it had last year, but I still think it's a play on the side that it's a group that will outperform as we move through the year.
Hey, Matt, let's talk about large cap tech for a second, because this is the group that's been really vulnerable, right, to rising yields. And it's a group, and we're looking at the heat map of the NASDAQ 100 today. It's a group where we have seen, after that initial rally this year, a lot of stocks sort of rolling over. But the one in the middle has not rolled over as much, or at least it's kind of bounced back here, and that's Tesla that I'm talking about. We have the investor day tomorrow. I know that's when you've been watching. How are you thinking of it as setting up going into that, since it's been a little bit more resilient?
Yeah, it's definitely going to be a bellwether. It's kind of funny because some people really get frustrated with saying that Tesla is a bellwether because, obviously Apple is a much bigger, in terms of, much more product out there. And it's in many more homes, et cetera. But its market cap, they obviously compare with one another, number one. But number two, whether we like it or not, it does move with the market. And it has been holding up, as you say. And I'm a little worried that we've seen Microsoft roll over. We've seen Advanced Micro Devices roll over, Taiwan Semiconductor, Google. A lot of these big cap tech names have, again, they've only curled over. I'm not saying that, obviously they haven't fallen out of bed and tested their lows from last year, but they are starting to roll over where Tesla's held up. And I just think that everybody's just so, oh my gosh, Elon Musk, he's going to have, he's going to do his usual magic on the investor day. The stock's going to do better. And then, but like I said, it's holding up near its recent highs, unlike most of the other big cap tech names. What happens then? What happens? Do we get the sell the news reaction to that investor day, or does, for the first time in a long, long time, does Musk not deliver? A lot of people are going to be caught off sides if that's the case. So I'm a little bit worried about Tesla after a double in the last 2 months. How well that can really hold up after we get past this investor day tomorrow.
And then if it is indeed a bellwether, what does that imply for the rest of the market, particularly other large caps that have already rolled over?
Yeah, I mean, again, most of these names. I mean, Google is now getting, or say Alphabet, I guess I should say, is relatively cheap stock. It's price earnings ratio in the mid-teens. But many of these other stocks are still, Apple's still on the expensive side, Microsoft's still on the expensive side of history. And as Tesla comes down, I guess my point is, if we get the individual investors heavily involved in Tesla, both the stock and its options, if they start to throw on the towel, I think that'll allow some of the other stocks, those we just talked about, to roll even further. And that could cause the kind of sell-off we have seen many times in March. The good news is, like I said, sometimes March gives us that bottom. I just worry that it's going to be at a level that's significantly lower than we are right now.
Yeah, a painful bottoming process, perhaps. Thanks so much, Matt. Good to catch up with you. Have a great day. Matt Maley is Managing Director and Equity Strategist at Miller Tabak. Thanks.